Once again, thank you for your interest in GMO and the Phillip Global Quality Strategy. Let's just quickly run through what I like to say is a thought exercise. And this is where I point them to what we call quality investing. So what this strategy tries to do is it gives you exposure to very responsible growth, gives you exposure to secular growth sectors of the world, but it does so at very attractive valuations or responsible valuations so that you can enjoy a good night's sleep. What this GMO quality strategy is about? Well, it is a flagship global equity strategy at GMO. It's something that we've been running for the last 17 years. We incepted this strategy in 2004. It has over 10 billion in assets. And if you look at its performance, the chart on the left, you'll see that we have generated close to 9.5% in annualized returns net of fees, with a volatility which is about 25% lower than that of global equity markets. So it has a very long and consistent track record of risk-adjusted return. It's investing in some of the world's best businesses, and there are co-portfolio managers for this strategy, Tom Hancock and Ty Cobb, and they've been working for the better part of 30 years together. So they have a deep understanding of both the markets and how they work with each other. So what exactly is a quality business? Now, I will define it both quantitatively and qualitatively. Quantitatively, quality businesses, companies that have high profits, stable profits, and they do so with low leverage. But qualitatively, we are looking for companies that have very high returns on capital. We are not after businesses that are, exploiting some kind of a historical niche that will be eroded away, but businesses that will remain for 10, 15, 20 years down the line. And finally, capital discipline. We want to understand how the management allocates its capital, because we want them to allocate it to projects that generate revenues and profits in excess of inflation. What does GMO quality look like? So what we are trying to do in the strategy is give you exposure to the secular growth sectors, but at responsible valuations. And that's why you can see the middle bar looks quite similar to the bar on the right, which is the growth sector. So we have in exposure to IT, healthcare, communication services, and consumer discretionary. But we do so at very responsible valuations. And I think that's where the similarities end. The GMO quality portfolio, we are trying to get exposure to high growth sectors at responsible valuations. And you can see compounding, as I say, it only works if you're able to participate on the upside, but also protect your capital on the downside. And that's the main focus of the strategy, is to protect the downside and participate in the upside. Something in mathematics we call the high Sortino ratio. So you need to have a high Sortino ratio. And this strategy does that. And you can see our performance through time, but not only through time, but in critical years such as 2008, 11, 18, and the first quarter of last year. We significantly protected capital. This is our investment process. Now, we start with a global investment universe of about 2,000 stocks. These are large cap stocks. We use our quantitative screen. So GMO, we've been doing quant since 1981. So we have a very, very strong data infrastructure, and we use that. Once we do that, out of that 250 odd bucket, we do deep fundamental vetting. So we go and speak to the company management. We look at 10Ks. We look at their competitors. We speak to suppliers. We understand industry dynamics. And then that kind of goes into the portfolio. But then we go through what we call the portfolio construction process, which is the last bubble, where we look at, is our portfolio well diversified across countries, across businesses, across policy risks, and that's how we come up with a very high conviction portfolio. Today, the portfolio has a little over 40 stocks in the strategy. This day and age, when we live in a very flat world, your domicile really doesn't say much. And you can see, for instance, Texas Instruments, it's domiciled in the US, but only 12% of its revenues come from that country. Similarly for Coca-Cola, Nestle, TSMC. So it's fundamentally a very, very global portfolio. For compounding to work, you need to win more often and lose less often, which means you need to protect capital on the downside. And as you can see on the chart on the upper right, we have participated on the upside quite frequently and protected capital on the downside, which leads you to the chart on the left. And as you can see, then the quality strategy net of fees is delivered close to 10% with far lower volatility than any of these. And that's why tricky periods over the last 12 years, we've done quite well versus some of the broader indices.